Hello and welcome. This is Shobha Potutvansa, Unlocking Strategies for Income and Investment Diversification. Today we are going to talk about a topic that I get a ton of questions from everyone I meet with. And some of the questions are, is my tax risk high or low? How would a high or low tax environment potentially impact my plan for retirement? Before we begin, if you want to know how to evaluate your situation, click on the calendar link in the description below for a complimentary one-on-one session. Most important thing in planning is making sure you're building flexibility and managing your tax brackets to match your desired income in retirement. I'm sure many of you might have heard that taxes are going to go up in the near future and are worried about how they will affect you. This is a cause of concern for all of us. But by understanding taxes through a historical perspective and positioning your wealth correctly, we can ensure that you maximize the wealth you have earned for your retirement. In today's video, I'm going to show you how to mitigate the risk of high or low tax environment and build flexibility into your plan so you can keep more of your hard-earned money. Let's get into the details. The majority of us put our savings into tax-deferred vehicles where we don't have to worry about paying taxes today, but we'll have to pay at some point in the future. This strategy will only work well if taxes are the same or lower in the future than they are now. Here, if you look at an example, 1985 married couple filing jointly making $250,000 would be subject to a steep marginal tax rate of 50%. Whereas the same couple making $250,000 would be subject to a 24% marginal tax rate today. Therefore, we can see that while taxes seem high right now, from a historical perspective, they are fairly low. So the question is, do you think that taxes are going to be higher or lower in the future? And do you have a plan that would work well in either scenario? That all depends on individual situations. Now, taking a look at this graph for a historical tax rates, we can see from the graph that we are actually in a low tax rate environment today. We all know, though, that taxes are rarely consistent. So the question becomes, how do you protect your wealth in such turbulent conditions? Do you have a plan that can work if taxes go up or down? Will you have enough saved up for any future needs or for your retirement? These are some of the questions that can only be answered with your plan and how much of a flexibility and diversity you built into it. That brings us to my note for today. There are only 3 ways to save money and build wealth from a tax perspective, and they are tax deferred accounts, taxable accounts, and tax advantaged accounts. This is not a video that will advise you on taxes or say one account is better than other. There is no one right account or approach. It is all about understanding each of these accounts and positioning yourself right so you can enjoy your retirement to fullest. Let's start with the one you're probably most familiar with, tax deferred accounts. Your 401k, 403b, IRA, SEP, Simple. This is where we put money that's not been taxed yet. But the idea is at some point in the future, we have to pay taxes on the contribution and growth, which means we are just delaying the taxes. There are some penalties that may apply if you access your money prior to a certain age. You just need to be aware of that one. Next is taxable accounts. We all are familiar with this. You put in after-tax money, you receive a 1099 with your earnings and gains, and also the taxes you owe on it. Taxable accounts are like money market accounts, mutual funds, or CDs. Then comes the tax advantaged bucket. Many of you are familiar with Roth IRA, but probably not with the life insurance plan where you put after-tax dollars, and if structured right, you will not pay taxes on that gain. So to help you understand if there is a gap in your plan or you want to revise your plan or revisit your plan, I have a small activity designed here. You may want to grab a pen and paper to work on that. Now let's draw 3 boxes. Label first one as tax qualified plans. The second one as non-qualified plans or assets. Third one as tax advantaged ones. Question is, do you know how these different things work? Whether you know or not, you can still work on this activity to help you understand your current situation. I highly encourage you to work on this activity with your spouse. Now, tax qualified plans, you put before tax money and tag it as pre-tax. Non-qualified plans, you put after tax money, tag it as after tax. Tax advantage plans is after tax money, tag it as after tax. Now, let's look at how the gains on each of these boxes are treated. Tax qualified plans, this is not being taxed yet, so your principal and gains are taxable. Non-qualified plans, this is after tax money gains are taxable. Tax advantage plans, it could be tax-free if designed right. So what kind of assets go into each of these boxes? Your 401k, 403b, IRA, SEP, simple, they all go into tax qualified. Your mutual funds, CDs, money market, etc., go into non-qualified investments or assets. Your Roth IRA or cash value life insurance plan go under tax advantage box. Now let's write down all of your assets and current balance under appropriate buckets. Maybe you have a 401k, stick that amount under tax qualified. Your IRA under tax qualified. You may have a CD, stocks, you want to stick that down in your non-qualified. You have a Roth or cash value life, you stick that down under tax advantage box. Now, after you complete this exercise, take a look to see if you have assets in each of these three boxes and at what percentage. Key here is to diversify. You need to have financial plans and strategies that are well balanced. You probably will never have assets equally distributed across all the boxes, but you need a substantial amount in each of the three boxes. And the reason for that is simple. You need to have a plan that works under a variety of circumstances. Like I always do, I encourage everyone to diversify. Don't put all your eggs in one basket. In the next part of the video, we will look at the scenarios, how a low or high tax rate environment would work for you with non-diversified assets and diversified assets. Let's go there. If you're going to have all your money sit in that tax qualified bucket, like 401k or IRA or SEP, in a perfect world, if taxes remain same or lower in the future, and if you don't need money until retirement, markets stay up all the time and never go down, then that's the best plan you could ever have. But if any of those factors like same taxes, access to money, markets staying up don't happen, then there is no way to pivot your plan or shift gears. If you have a reverse situation, you retire and you have all your assets in a tax deferred vehicle and you have deferred taxes from a 24% marginal tax rate, you are into retirement and tax rates are really high. Let's assume they are gone up to 45%. Would it make sense to take the money out of a tax deferred account when you defer taxes at 24% and finally ending up paying 45%? It doesn't make any sense at all, right? Now, what if you diversified and also have money sitting in tax advantaged vehicle, which is life insurance or Roth? If you're in high tax environment in retirement, you can leverage the tax advantaged bucket and take money out of Roth or life insurance. If designed right, you pay zero taxes when you take out of that life insurance vehicle. Also, it could create a tax-free legacy subject to IRS regulations and conditions. It also awards living benefits that you don't have to die to use. We will not get into the details of living benefits today, but if you want to know more, I have another video. I highly encourage you to watch the video on living benefits. Now, if there is a reverse situation, you are in retirement and you deferred at 24% and taxes in retirement are at 21%, then you can take money out of your 401k and you will end up paying less taxes in retirement. Now, as you have seen, diversification is the key and the way to build flexibility into your financial plan and manage your tax brackets. Would you be interested to know how if this strategy worked for you? Want to create a more balanced plan without any additional outlay? You can schedule for a personalized discovery call by clicking on the calendar link in the description below. This is Shobha Pottuitwensa asking you the question, is your income and investment diversified? Thank you for watching. Please comment, like, and share the video. Don't forget to subscribe. See you next time.